Welcome, everyone. Today, we are unlocking the digital vault of corporate finance to explore the modern Treasury Toolkit. In a world of increasing cash velocity and market volatility, relying on outdated tools is a risk no firm can afford. Let's get started on building a world-class technology stack. Let's begin by defining the modern Treasury Toolkit. At its core, it is a cohesive, digital ecosystem of software and networks designed to manage a company's liquidity, funding, and risk. The basics of this transformation involve moving away from manual, human-dependent processes. Why is this critical right now? Because our latest data reveals that a staggering 74% of corporate treasuries still rely primarily on Excel spreadsheets. This reliance creates severe latency, limits real-time insights, and introduces massive operational risk. How are leading firms solving this? By aggressively pivoting toward modular, API-enabled, and cloud-native architectures. Taking a deep dive, this isn't just an IT upgrade, it is a fundamental paradigm shift. Equipping your team with a modern toolkit elevates the treasury from a reactive, back-office processing hub into a predictive, strategic control tower that actively shapes enterprise value. Take a look at this progression chart. On the left, we see the legacy treasury, heavily weighed down by Excel spreadsheets and manual, reactive workflows. As we follow the dotted line of digital transformation, we reach the modern toolkit in the center. This hub branches out into three critical technological pillars: cloud-native treasury management systems, real-time API connectivity, and advanced AI and analytics. When these three pillars work in harmony, they converge on the right side to form the ultimate end state, a strategic control tower capable of driving true business agility. At the very heart of the modern toolkit lies the Treasury Management System, or TMS. What is it? It is the central nervous system of your financial operations. The basics involve consolidating cash positioning, forecasting, debt management, and risk reporting into one unified platform. Now, the big question is, why are 81% of companies moving these systems to the cloud or utilizing software as a service? Because SaaS deployments drastically lower your total cost of ownership. You eliminate the need for heavy internal IT infrastructure and costly manual upgrades. How does this work in practice? These systems use multi-tenant, browser-independent architectures where the vendor pushes seamless upgrades to all clients simultaneously. In our deep dive, we see that modern SaaS TMS platforms are secure by design. They partner with global security agencies to defend your billions in cash against cyber threats, while offering advanced modules to run sophisticated structures like an in-house bank. This structural diagram illustrates the functional breadth of a modern cloud TMS. At the top sits your SaaS core. From there, it seamlessly delegates tasks into four main functional modules. On the left, liquidity management handles real-time cash positioning and global payments. Next is risk management, which actively monitors your exposure to foreign exchange and interest rate volatility. Then we have reporting and accounting, which automates complex ledger entries and hedge accounting. Finally, on the right, the in-house banking module manages internal workflows like intercompany netting. It is a comprehensive, all-in-one control center. A TMS is powerful, but it is useless if it cannot talk to the outside world. This brings us to our communication layer, Swift, APIs, and global standards. What are these? They form the digital plumbing connecting your internal ERP and TMS to your global banking partners. The basic goal here is straight-through processing, or STP, sending a payment from your system to the bank without a single human touch. Why is standardization so vital? Because historically, every bank had its own proprietary file format, making multi-bank integrations a costly administrative nightmare. How has the modern toolkit solved this? Through the Common Global Implementation, or CGI. CGI leverages the ISO 20022 XML standard, meaning you can send the exact same file format, like a Pain.001 credit transfer, to every single bank globally. For a deep dive, companies are now connecting directly to Swift using models like SCORE, utilizing FileAct for mass batch payments and FIN for urgent, high-value treasury wires. Let's trace a payment through this connectivity flowchart. It starts on the far left inside the corporate ERP or TMS. The system generates a payment instruction using the universal ISO 20022 XML standard. Because we adhere to the CGI standard in the middle node, we do not need to translate this file. It passes cleanly over the Swift network or via APIs simultaneously to Global Bank A, Bank B, and Bank C. The banks receive the standardized payload and instantly push it into the global clearing networks on the right. This architecture completely eliminates formatting translations, ensuring rapid, error-free global execution. Let's zoom in on a specific capability of your toolkit, working capital and liquidity software. What is this? These are the modules that give you X-ray vision into your global cash. The basics involve tracking your cash conversion cycle, monitoring receivables, and locating idle or trapped cash. Why is this the highest priority for many CFOs? Because if you have idle cash in Europe, but you are borrowing at high interest rates in Asia, you are bleeding value. You must mobilize your internal cash first. How does the software execute this? It connects to bank APIs to automatically pull intraday MT940 and MT942 bank statements, aggregating them into a single, real-time dashboard. In our deep dive, we see these platforms doing more than just reporting. They execute automated rules. If an account in Germany has a surplus, the software automatically triggers a sweep into a master zero balance account, instantly deploying that cash to pay down a deficit in another region. It is liquidity optimization on autopilot. This diagram illustrates the automated liquidity loop. At the top, we have live data feeds streaming in from intraday bank APIs and ERP payables. This data converges in the central liquidity dashboard. The system's cash position engine analyzes the data instantly. If it detects a surplus, it follows the right path to auto-sweep the funds to a master account. If it detects a deficit, it triggers an internal funding request. Both actions bypass expensive external borrowing, leading directly to the ultimate goal at the bottom, optimized working capital. The software does the heavy lifting so the treasurer can focus on strategy. Our next critical component covers trading platforms and risk management modules. What are these tools? They are the specialized portals where your front office executes foreign exchange, interest rate, and commodity hedges. The basics of a modern toolkit include seamless, out-of-the-box integration with industry-standard platforms like Bloomberg, Thomson Reuters, FSOL, and 360T. Why integrate these? First, to force banks to compete for your pricing on a multi-bank portal, and second, to protect your corporate profit margins from wild market volatility. How does the workflow operate? A dealer logs into FSOL and executes a multi-million-dollar currency hedge. Instantly, that trade data flows via API back into your TMS. For our deep dive, this automation is critical for compliance. The middle office system automatically checks if the dealer breached any trading limits, while the back office module instantly generates the complex hedge accounting entries required for IFRS 9 or ASC 815 compliance. It enforces a perfect segregation of duties digitally. Let's walk through the straight-through processing of a trade using this sequence diagram. First, the front office dealer requests an FX quote on a platform like FSOL or 360T. Second, the platform executes at the best competitive price. Third, the trading platform instantly pushes the trade data via API into the central TMS. Fourth, without human intervention, the TMS middle office module verifies that the trade is within approved risk limits. Finally, the back office module generates the required hedge accounting entries. The system ensures security, compliance, and efficiency in seconds. We now arrive at the cutting edge of the modern toolkit, the AI and analytics revolution. What we are talking about here is the integration of machine learning and generative AI directly into Treasury systems. The basics show massive momentum. Currently, 82% of surveyed professionals are actively planning or exploring AI deployments. Why is this a game changer? Because it fundamentally shifts Treasury from reporting the past hindsight to predicting the future foresight. How is it being applied today? The ultimate flagship use case is AI-led cash forecasting, which 26% of advanced treasuries are already piloting. For our deep dive, understand that AI excels where humans struggle. These AI models digest years of messy ERP data, accounts payable cycles, and seasonality trends to generate highly accurate liquidity predictions. They are also being deployed as security watchdogs, using pattern recognition to instantly flag payment anomalies or potential fraud before the cash ever leaves the building. This flowchart maps the flow of AI-driven intelligence. On the left, massive volumes of structured and unstructured ERP and bank data, along with external market feeds, are continuously ingested into the central AI or ML engine. The engine processes this data to output two critical deliverables. First, it generates a highly accurate predictive cash forecast, leading directly to optimized capital allocation. Second, it performs real-time anomaly detection, flagging suspicious activity to achieve ultimate risk mitigation. AI transforms raw data into actionable enterprise protection. Let's ground this in a highly practical, real-time use case. Imagine a multinational corporation that has millions in idle cash sitting in European bank accounts, while simultaneously paying high interest rates on overdraft lines in Asia. This is a classic liquidity trap. The action required: the Treasury team leverages their modern, API-first TMS to completely automate their cross-border liquidity. Instead of manually calculating balances and logging into banking portals, they configure a programmatic rule. Look at the sample JSON code on your screen. This simple API payload establishes a target balance sweep. It instructs the banking network if the source, Euro account 01, exceeds a €50,000 threshold at end of day, automatically sweep the excess into the global master pool. The outcome is profound. The system tirelessly centralizes global cash, instantly paying down the Asian debt internally. You completely eliminate unnecessary external borrowing, and your interest costs plummet, adding millions directly to the corporate bottom line. Let's walk through the technical execution of this sweep using a sequence diagram. The Cloud TMS initiates the process by sending an API POST request containing our JSON payload to the bank API gateway. The gateway validates the rule and passes it to the partner bank core, which returns a 200 OK confirmation. Now, the system waits. At end of day, the bank core autonomously checks the account. Finding the balance exceeds 50,000, it executes the transfer to the master pool. Finally, it fires a webhook back to the TMS, instantly updating the treasurer's dashboard. Flawless, automated execution. To summarize, building the modern Treasury toolkit is about moving away from rigid, monolithic legacy systems and heavy spreadsheet dependency. The future belongs to a flexible, composable architecture. This means seamlessly integrating the absolute best-of-breed SaaS TMS, specialized trading platforms, real-time APIs, and predictive AI models into one dynamic financial ecosystem. As we look toward the 2030 vision, the Treasury Department must transform into a digitally native control tower. This requires professionals who are hybrid thinkers fluent in both complex finance and modern technology. Your next steps: audit your current operations to eliminate manual spreadsheet risk, rigorously evaluate cloud-native TMS solutions, and pilot high ROI AI use cases like cash forecasting. I encourage you to take the lead in digitizing your firm's financial core. Please invite your learners to like this video, subscribe to our channel, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Thank you for joining me. Our final diagram illustrates the hub and spoke model of a composable Treasury architecture. At the center is your core cloud TMS. Branching out, you plug in best-of-breed modules, API connectivity using ISO 20022, specialized trading platforms like FSOL, and AI predictive analytics. These components are modular. You can upgrade one without breaking the others. All these intelligent spokes feed directly into the ultimate goal at the bottom, a future-ready Treasury built for 2030 and beyond. Equip your team with this toolkit, and you will drive unparalleled strategic value.